For most people, debt feels like a personal issue. A mortgage, a credit card, a student loan, a bill they plan to deal with later. But what almost no one realizes is this. Debt isn't just a personal burden. It's the foundation of the entire global economy. It's the engine behind government spending, the fuel behind modern banking, the reason inflation exists, and the quiet mechanism that transfers wealth every single day. And the most astonishing part? You're inside the system whether you choose to be or not. You earn inside it. You save inside it. You spend inside it. Your future is shaped by it. Because for more than a century, the world's most powerful nations have run the same hidden pattern, a self-reinforcing debt cycle that extracts value from ordinary people while enriching the institutions that created it. This is not a conspiracy. This is not hidden in secret documents. This is the architecture of the modern financial world. It is the most powerful debt scam in history, and it has been operating in plain sight. The stakes. Why does this matter now? Because the scam accelerates during moments like today, when inflation rises, interest costs explode, and governments borrow at record speed. Debt is no longer a temporary policy tool. It has become the system itself. And the people who understand how it works make decisions that protect them. Those who don't pay for the entire cycle. Understanding this pattern isn't just important, it's necessary. Because every major economic shift of the last century has been shaped by it. Currency collapses, inflation waves, boom-bust cycles, wealth inequality, market shocks, global financial crises. They all originate from the same underlying structure. This episode reveals the architecture, the design, the incentives, and the history behind it. Once you see the scam, you cannot unsee it. 2. The debt system is designed, not accidental. Here is the core idea. Modern economies grow through debt first, production second. Governments spend money they don't have. Central banks create money that doesn't exist. Commercial banks multiply that money through lending. Inflation erodes purchasing power. Debt becomes cheaper to repay, and the cycle restarts. This is not an error. This is not mismanagement. This is the design. The system rewards expansion and punishes discipline. It redistributes wealth upward, from savers to debtors, from workers to asset owners, from the public to the institutions that control credit. This is the hidden truth. Debt is not the problem. Debt is the product. Governments need it. Banks profit from it. Central banks manage it. Elites leverage it. And ordinary people finance it, without realizing it. This cycle has existed in various forms for centuries. And every empire that mastered it gained extraordinary power, until the cycle became too large to sustain. That's the pattern we explore next. 3. Episode Roadmap. Here's what we'll uncover in the next sections. 1. How the debt scam actually works. The four-phase pattern used by governments and central banks. 2. A deep dive into the British Empire's debt machine. How the pound dominated global trade through controlled inflation and strategic borrowing. 3. A shorter case study on Weimar Germany. The extreme version of the pattern when debt overwhelms confidence. 4. The modern system. The US, global finance, inflation, and the new debt supercycle. 5. The transformation point. What happens when the mathematical limit arrives? Finally, we connect all the dots and deliver a sober, historical warning. 4. Early teaser. Before we break it down, here is the quiet secret behind the debt system. Debt doesn't collapse because inflation hides it. Until it doesn't. Every empire has believed it could control the cycle indefinitely. None have succeeded. And today's system has pushed the cycle further than any in history. But to understand the scale of the modern pattern, we must first understand the mechanics, the structure, the incentives, the logic that keeps the scam running. Chapter 1. The core pattern, how the debt scam works. The debt scam operates through a repeating four-phase cycle. Every major modern crisis sits somewhere inside these phases. Let's break them down. 1. The creation phase. Debt becomes the fuel. In the first stage, governments begin spending more than they earn. They run deficits. They issue bonds. They borrow from future generations. Central banks then step in, not directly at first, but through mechanisms that support the lending system. As spending grows, the economy becomes addicted to credit. Debt fuels growth. Growth justifies more debt. And the cycle becomes mandatory for maintaining economic stability. Once a country adopts this model, it cannot return to restraint without triggering recession. This is why the scam is so powerful. There is no political incentive to stop it. 2. The inflation phase, the hidden tax. Inflation is not an accident. It is the mechanism that makes unsustainable debt appear sustainable. Here's how. Governments borrow money. Over time, inflation reduces the real value of what they owe. They repay the debt in dollars that are worth less than the dollars they borrowed. It is the quiet, mathematical transfer of wealth from citizens to the state. Savers lose purchasing power. Wages lag behind. Assets rise. Creditors suffer. And the people who hold real wealth, land, resources, assets, gain even more power. Inflation is the lubricant of the debt engine. 3. The extraction phase. Wealth moves upward. This is where the scam becomes visible to anyone who looks closely. Banks profit from interest. Governments benefit from devalued obligations. Central banks gain more influence. Large corporations gain access to cheap credit. Asset owners see their holdings rise. Meanwhile, the middle class loses savings, the poor lose purchasing power, retirees lose fixed income value, workers lose wage strength. The cycle extracts wealth from the many and concentrates it with the few. It is not a conspiracy, it is math. 4. The reset phase. The system cleanses itself. Eventually, the debt becomes too large. Interest payments rise. Inflation accelerates. Confidence weakens. A shock arrives. Financial crisis, war, policy change, or market collapse. The system resets. Debt is restructured. Currency regimes change. Rates fluctuate. Institutions reassert control. The public absorbs the losses. Then, the cycle begins again. Every empire has used this model, but none used it as effectively as the British Empire. And that's where we turn next. Chapter 2, Historical Case Study Number 1. The Birth of Perpetual Government Debt. The story begins in London, early 1700. A small island nation was expanding rapidly, militarily, commercially, and geographically. But expansion had a price. By 1694, England was nearly bankrupt after years of war with France. Traditional taxes and royal credit were no longer enough. The crown needed a new system, something bigger, something permanent. That system would become the foundation of modern debt itself. In 1694, a group of wealthy merchants and financiers proposed a plan. They would lend the government £1.2 million, an enormous sum at the time, in exchange for two unprecedented privileges. First, they would earn fixed interest paid directly through taxes. Second, they would receive a charter to create a powerful private institution, the Bank of England. This was not just a bank. It was a debt machine. The moment the ink dried, a new pattern emerged, one that still governs the world today. The government gained access to endless borrowing, and the private financiers gained control over the flow of money itself. England would no longer fight wars using its own savings. It would fight wars using borrowed money, supplied by a small group of creditors who profited from every new conflict. And once the system was created, it expanded with astonishing speed. War of Spanish Succession, 7 Years' War, American Revolution. Each conflict added layers of debt that never fully disappeared. Each crisis made financiers more indispensable. And every time the government searched for funds, the same answer appeared: borrow again. By 1815, after the defeat of Napoleon, Britain's national debt had reached an amount equal to 250% of its GDP, the highest in the world at that time. It was enough to crush other nations. But not Britain, because perpetual debt didn't weaken the empire. It powered it. Money flowed from colonies into London, taxes fed the debt machine, and creditors tightened their grip. This was the first time a country discovered that debt could be more than a burden. It could be a business model, a perpetual, interest-bearing engine, owned by the few, fueled by the many. And the key insight from this chapter is simple. Once a nation becomes dependent on borrowing, control quietly shifts from elected governments to creditors who cannot be voted out. Chapter 3, Historical Case Study Number 2. The Modern Upgrade, the Dollar and the 20th Century Debt Machine. Jump forward 2 centuries. The world has changed, but the incentives remain identical. This time, the center of gravity is no longer London. It's Washington. After World War II, the United States emerged as the strongest economic and military power on the planet. At Bretton Woods in 1944, the dollar was declared the world's reserve currency, convertible to gold, trusted globally, and backed by unmatched industrial strength. But behind the scenes, something else was happening. Something bigger. Something far more profitable. The US government realized it could run the British playbook at a global scale. If other nations needed dollars, and they did, then America could issue debt endlessly, and those dollars would circulate worldwide. Instead of colonies, the US would have trading partners. Instead of taxes funding the system, global demand for dollars would do the work. But there was one constraint: gold. As long as dollars were tied to gold, the system had limits. Spending required discipline. Debt required restraint. By the late 1960s, that restraint was breaking. The US fought an expensive war in Vietnam. Domestic spending surged. Trade deficits grew. And countries like France began demanding gold in exchange for their dollars. The entire structure was at risk. Then, in 1971, President Richard Nixon delivered the move that transformed the global economy forever. He closed the gold window. The dollar was no longer redeemable for anything. Money became credit. Credit became infinite. And infinite credit needed buyers. Just like in 1694, a new class stepped forward: central banks, commercial banks, and institutional investors who purchased U.S. debt in unimaginable quantities. Treasury bonds became the backbone of global finance: safe, liquid, dependable. But what made them safe was not stability. It was scale. The sheer size of the market and the global dependency that came with it guaranteed that the system would never be allowed to fail. This was no longer just a national debt machine. It was a planetary one. Countries held U.S. bonds as reserves. Corporations borrowed in dollars. Governments settled trade in dollars. And every expansion of global debt made the American system stronger. The lesson from this chapter is identical to the one from Britain, only amplified. Once the world runs on your debt, you control every crisis. Because every downturn, every panic, every collapse pushes nations, banks, and investors to buy even more of your debt as safety. The machine feeds on instability, and the world keeps providing it. 7. Present-day application: the modern debt trap. Today, the pattern is no longer hidden. It's global, coordinated, and more powerful than at any point in history. Governments run deficits not occasionally, but permanently. Central banks create money not rarely, but continuously. And the financial system expands through a cycle that rewards debt, punishes savings, and ensures dependency at every level, from households to entire nations. But here's the key: this system no longer behaves like a traditional economy. It behaves like a controlled ecosystem, engineered to produce predictable outcomes that benefit the institutions closest to the flow of money. And just like Britain in the 1700s or the US in the 1970s, today's global economy runs on a simple principle: money must constantly be created, borrowed, and rolled over, forever. If the debt stops expanding, the machine stalls. If the machine stalls, markets fall. If markets fall, governments panic. And every panic justifies the same solution: create more money, issue more debt, increase the scale. We saw it in 2008. A global financial system built on leveraged bets collapsed under its own weight. But instead of letting the system reset, central banks stepped in with trillions of dollars in rescue programs. The crisis made the machine stronger. We saw it again in 2020. Supply chains froze, economies shut down, and demand collapsed. Yet global markets surged to record highs because central banks injected unprecedented amounts of liquidity. The crisis made the machine stronger. And we see it today. Inflation rises. Currencies weaken. Debts balloon. Yet the institutions that manage the system, central banks, treasury departments, major financial intermediaries, expand their influence. The crisis makes the machine stronger. The modern world is trapped inside a cycle where every downturn reinforces the authority of the same entities that produce the very conditions of instability. This is why governments cannot allow interest rates to remain high for long. It's why inflation is tolerated, even quietly welcomed. It's why long-term austerity never lasts. And it's why the debt curve of every advanced nation slopes upward, smoothly, predictably, uncontrollably. Because the debt is not a flaw. It is the foundation. And foundations are not allowed to crack. 8. Synthesis: the unbroken pattern. If you zoom out, the entire story becomes strikingly simple. 3 centuries ago, financiers in London discovered that debt could be perpetual. 1 century ago, America discovered it could scale that discovery globally. And today, the financial system has evolved into a structure where crisis is not the enemy. It is the fuel. The pattern has three parts. 1. Create dependency. Nations become reliant on borrowing to fund everything from wars to welfare. Once dependent, they cannot easily stop. Stopping means collapse. 2. Expand the market. More countries join the system. More institutions buy government debt. More savings flow into financial products built on debt. The machine becomes too large to fail. 3. Stabilize through crisis. Every major downturn, every panic, crash, recession, results in larger interventions. More liquidity, more bonds, more control. The system becomes stronger after each collapse, not weaker. It's the same three-part pattern seen in Britain, seen in the US, seen in every major financial hub that followed. Debt is not merely a tool. It is a hierarchy, a structure that rises step by step until every part of the global economy becomes linked to a small circle of institutions that manage the flow of money. And once you see that structure, you can't unsee it. 9. Final warning. The system always ends the same way. Here's the truth history tries to whisper again and again. Every debt machine eventually hits its limit. Not because the numbers stop adding up, but because people do. No society tolerates permanent inflation forever. No generation accepts declining purchasing power indefinitely. No empire maintains global confidence without interruption. There always comes a stage, quiet, gradual, then sudden, when the public realizes the system is not designed to serve them. It is designed to use them. When that moment arrives, the pattern changes. Debt becomes political. Currency becomes contested. Trust becomes scarce. And the institutions that once seemed invincible begin to face pressures they cannot fully control. History shows this every time. When a debt system reaches maturity, the next collapse is not financial. It is social. It is political. It is structural. And the world today is closer to that stage than at any point in the last 50 years. Not because the system is about to vanish, but because the system is about to transform. Debt machines don't die quietly. They remake the world around them. And everyone inside the system, nations, investors, families, is pulled into the transition. If you've watched this far, then you're not just learning history. You're decoding the present and preparing for the future. This channel is built for people who want to understand the real forces shaping the world, quietly, continuously, and often invisibly. So if you want to follow the next chapter of how global finance evolves and where this pattern is heading, subscribe. Because the story we're living through now is bigger than any collapse behind us.